Hello, all, and welcome to this exciting business case study. We are thrilled to take you through an insightful journey of one of India's most talked about fintech giants, Paytm. I am Sampada Ketkar.
And I am Jitendra Rawal. We are student of PGDM Business Design at V School Mumbai.
In this case study, we'll explore how Paytm evolved from a simple mobile recharge platform to a massive fintech ecosystem. But most importantly, we'll analyze whether that evolution was enough to achieve what every business ultimately aims for, that is profitability. So sit tight as we decode the business model shifts, regulatory challenges, and strategic pivots, and the core lessons from Paytm's journey.
Let's begin with a quick overview of Paytm itself. Paytm, short for Pay Through Mobile, was launched in 2010 by Vijay Sekhar Sharma, initially to help users recharge their phone online. Back then, digital payments were not mainstream, but Paytm spotted the gap early and built a solution that was fast, simple, and user friendly. The real game changer came in 2016 with the Indian government's demonetization decision. Paytm seized this moment and its QR code suddenly appeared everywhere, from local chai stalls to large supermarkets. Over time, Paytm expanded its services to include bill payments, ticket bookings, digital wallets, bank accounts, investment tools, and even insurance. Today, the platform serves over 30 crore users and 1 crore plus merchants, making it cornerstone of India's digital economy. Paytm operated in a rapidly growing but highly competitive fintech space, offering a wide range of payment and financial services. However, it struggled to achieve sustainable profitability due to low margins in core payment services, intense competition from players like PhonePe and Google Pay, and an increasingly complex regulatory environment. The key challenge was building a business model that could scale revenue effectively while ensuring a long term financial sustainability.
Let's now take a look at Paytm's evolution over the years, step by step. In 2010, it was launched as a mobile recharge platform. In 2014, it introduced its digital wallet, among the first in India. The 2016 demonetization led to a surge in users and merchants. In 2017, it launched Paytm Payments Banks, offering zero balance digital accounts. Between 2018 to 2020, Paytm diversified into Paytm Gold, Paytm Money, and point of sale devices for merchants. Between 2021 to 2024, it added co-branded credit cards, loan distribution, insurance, and subscription-based merchant tools like the famous Paytm Soundbox. These changes weren't just about expansion. They represented strategic moves to generate revenue and retain users beyond basic payments. Let-
Let's understand how their business model actually helped them navigate these challenges. To tackle the challenge of low margins, Paytm switched to a platform based business model. The idea was simple: use payments and UPI as entry points to bring users in. Then, instead of earning from the transaction themselves, they started monetizing the ecosystem around it. For merchants, they introduced devices like soundbox and POS machines. These were not just a tool, they created a stream of subscription revenue. On the consumer side, they added value added services like movie tickets, gift cards, credit cards, and even loan access, all within the app. But their smartest move, expanding into financial services like mutual funds through Paytm Money, insurance, and small ticket loans in partnership with banks and NBFCs. So, Paytm evolved from just handling payments to becoming a full lifestyle and financial ecosystem. Now, let's decode how Paytm actually made money across its services. First, we have payment services. While UPI brought in huge volumes, the revenue from it was minimal. But for credit card transactions, and merchant payments. Paytm earned through merchant discount rate. So this helped in building brand recall and stickiness more than revenue. Second, device and subscription. Over 1 crore merchants used Paytm Soundbox and POS machines. The Soundbox alone came with a rupees 999 upfront cost and a rupees 99 monthly subscription. This gave Paytm a stable and recurring income stream. Third, marketing and credit services. Paytm launched co-branded credit cards with SBI, HDFC and Kotak and issued over 12 lakh cards. For each card, Paytm earned from activation and usage-based fees. And finally, financial services. This is where margins were high. Paytm partnered with banks and NBFCs to offer personal and merchant loans, earning revenue on both sourcing and collection. Paytm Money also contributed with income from mutual fund investment, stockbroking, and account related fees. So, while core payment services didn't generate much profit, these layered revenue streams, subscription, loans, credit cards, and financial products help Paytm diversify its income in a sustainable way.
This business case can be better understood through a few strategic frameworks. The first one is platform ecosystem model. Paytm operated a two-sided network, users on one side and merchants on other, with services flowing in between. Second, business model innovation. The company constantly redefined its core from recharges to wallets to loans and insurance. Third, SWOT analysis. The strengths being brand equity and massive user base, weaknesses being low margin on core services, opportunities as financial products and B2B tools, and the threats being regulation and competition. Fourth, diversification strategy. It helped de-risk over reliance on one vertical and enabled cross-selling. These framework highlight on how Paytm tried to balance growth, regulation, and monetize in a tough environment. This case is packed with academic insights that go beyond just fintech. Scale is not always equal to profit. Having millions of users doesn't guarantee income unless there is a clear monetization plan. Regulatory compliance is critical. A single RBI policy change in 2024 disrupted Paytm Payments Bank. Diversification is essential. Businesses must expand into higher margin offerings, especially in low margin industries like payments. Retention is more valuable than acquisition. Paytm built a sticky ecosystem by offering bundled services. Adaptability wins. Paytm constantly reinvented itself in response to market changes, regulatory pressures. These lessons apply to any startup or platform business navigating scale and sustainability. That brings us to the end of our case study on Paytm's business model evolution. From mobile recharges to digital banking and now lending and insurance, Paytm's journey has been both inspiring and complex. It teaches us that innovation, diversification, and adaptability are not just buzzwords, they are necessary for survival in today's dynamic business landscape. If you found this video insightful, please do like, share, and comment below with your thoughts or questions. And don't forget to subscribe for more such breakdowns on business strategy, innovation, and design thinking. Thank you for watching. Have a great day. Bye.